Whether we accept it or don't accept it, markets are driven by smart money. Basically, those who have the big money, even if they enter with a smaller positions in the market, that can impact the most. And the question here is, how can we identify their presence and how can we align with their direction before it happens, especially in intraday? That is exactly what the purpose of today's video. So I'm going to discuss about this strategy for intraday in a detailed manner. This is called as a masterclass, where we discuss about a specific subject in a detailed manner. If you want to understand this completely, it is highly recommended that you watch this video till the end to get the complete clarity. And if you don't want to miss any of these kind of interesting updates about trading, kindly consider subscribing to the channel and also click on the bell icon to get the regular updates. Without any further ado, it's me, Nataraj Malavade. Let's get started. Well, let's start our video by understanding the key concept of today's video, which is extreme. Let me explain you what it is using the help of screen. Assume market has opened at 100 rupees. Okay, so this is an example, and from here market would be moving up and down and everything will be happening, right? So at the end of the day, if you observe, market would be closing, right? So if you consider the closing price, it would be closing between two different extreme points. One is the high. This is a daily candle. Assume this is a daily candle. Another one is a low. This point is what we can call as extreme points. Why this is important is because when market approached this particular, assume it is 150 points. Okay, so when market approached to this 150 rupees price, someone who has the big money thought that this is the best price to dump their positions. That could be, even the smaller positions also. If they are dumping that positions at this particular level, that is what, as a reaction to that, we are getting this particular peak, and at the end of the day, market closed here. So always market closes between two different extremes, and that extreme is what helps us, or in a glimpse we can identify that the someone who are smarter, or basically those who have the big money, have entered the market at the extreme level, and that is what help us to understand or identify the footprint, the first initial footprint of this smart money. I hope this is clear. In the same example, assume market was trading at was opened at 100 rupees, and again it approached to around, assume it is 80 rupees. When that happened, someone who has the big money, who has the long-term thinking, might be thinking, or maybe they would be entering here with some of their positions by keeping long-term perspective to buy the market. So which is what resulted in creating this particular low point here, and market again settled down at close. So here we are going to identify the day's high and day low. For example, assume you are trading tomorrow, right? You are planning your trades for tomorrow. You would be identifying previous day's high and low, and you would be monitoring the price to reach this particular level to take further actions. Don't worry, I'll be discussing about each and every points with respect to strategy in the coming sections. I hope this is clear. Let's move on to the next example. And now we need to understand the concept of support. Let me write it down. Support and resistance, right? It's a very basic concept that comes in price action trading. Basically, as the name implies, support means what? It gives support to the price. When market approaches to these levels, obviously market will take some kind of support from that particular level, and market try to move upwards. So why this happens? For example, assume let's take an example here. Okay, so assume market is trading like that, and for example, in this particular case, the last low was here. The last lowest peak was here. When market approaches to this particular price level, someone assume that from this particular price level, market reversed, right? So someone who have the big money, or basically who want to get into the market for a longer duration, so they might have entered their positions at the discounted level. When again market approaches to the same level, there is a higher possibility that market can take support of this particular level and it can move in the higher direction. So or basically it can anticipate the same kind of behavior from the same price level. Why? Because those people who entered with the bigger positions at this particular level earlier can again pitch in the market, and they can defend their positions. If they fail to defend this particular level, what would happen? Obviously market would start moving in the downward direction because they are now giving up. This is an important point of support and resistance. See, by default there is nothing called as support and resistance. All are the key levels. The reversal levels, for example, market reversed here, right? So earlier next time when market approaches to the same level, this will become a critical level because earlier someone entered here. That's why we are now getting to know that this particular price level is very crucial, and that is what we are going to call as support. So for example, in this particular case, price was trading above this key level. So that is why we are going to call this particular level as support. As long as price trades above key level, we are going to call it as support. Imagine that market has broken this particular level. All right, market has broken this particular price level, and now price is trading below the same key level, and the same key level now becomes a resistance. And when again market approaches to the same level, we can expect market to continue in the downward direction, and this is what the same support earlier now became the resistance. So support and resistance varies based on the price levels and the key level. So what we need to understand in this particular method or any particular basic price action method is that the reversal points, any reversal points indicates that there is someone who have the bigger position entered the market, point one. And when market approaches to the same level, we can expect the same kind of anticipation, or we can anticipate the same behavior from that particular level when market or when the price approaches to the same level. So same key level, we are going to compare the key level to the present price of the market. If the present price is trading below the key level, we are going to call it as resistance. We can call, okay, market approaches to this level, then we can expect some resistance. So similarly, if the markets are trading above that particular key level, then we are going to call it as a support. We can say when market approaches to the same level, we can think of getting into the long trade, or maybe we can think of anticipating a upper trend from this particular level. So support and resistance varies from the behavior of the price and the location of the present price with respect to the key level. So now we understood what is support and resistance, and similar concept we can think of deploying with respect to the PDH and PDL, or previous day's high and previous day low, or the extreme point. So for example, assume this is a PDH, and this is PDL. Okay, you have marked these two levels for any identifying opportunities for tomorrow. So assume market, you are trading today and market approach to this particular level. Only two things can happen: either market can break this level decisively and market can move in the upward direction, or similarly, if market is taking a resistance of this PDH, we can expect market to revert back to the previous levels, or basically we can expect market to reverse to the PDL, or at least the day's midpoint. Previous point is where we can expect market to reverse. Don't worry, I'll be showing some real life examples later, but try to understand the concept here. PDH and PDL play the critical role for intraday, point one, and point two, based on the price behavior at these key levels, we are going to identify the trading opportunities. And now, if this is clear to you, let's now understand the next key concept, which is acceptance and rejections. Very important concepts, because based on this, if you understand this particular concept very clearly, you can identify trading opportunities just like that with respect to the support and resistance concept. So what is acceptance? Acceptance is basically means that price is accepting above or below certain key levels. For example, assume this is resistance. In our example, assume this is a PDH. Okay, so market now approaches to this level, and I need your complete attention to understand this. This is a very important concept here. So market, assume this is a candlestick, right? This is an example one. Market closed here, okay? And I will show you another example, same PDH, right? Now my question to you is, what example you think as an acceptance or rejections? Acceptance means what? Acceptance of this bullish trend. So for example, we to call it as a breakout, there has to be something, right? So there has to be some parameter to call it as a breakout. So what is the book theory, or basically book definition of breakout? When market closes above the above the resistance level, we can expect, or we can think of it as a breakout. But here in both of the cases, market closed above the PDH, but there is a significant difference. I want you to think about it. So which one you think the breakout or the acceptance of the price above this particular level? Let me give the pause and let me know the answer. What you think about it? Let me know in the comments. So here the first example is an example of acceptance of this bullish trend. But the second example, the possibility of market moving in the upward direction in the second example is quite low. Why? Because of this rejection. As you can see, rejections or acceptance is what we can easily identify using the help of wicks. Wicks are very, very important. Many people think body is also important, but more than that, wicks plays the critical role in candlesticks. So if you observe the wicks here, there is a significant rejection from the higher level. Someone is showing a good interest at the higher level. Who would you think that who would show the interest at the higher levels? Obviously someone who can defend, or someone who have the bigger power, and they can only sell at this particular price level against to the flow of the market. So obviously they have the power, they have the money, and that's why we can easily identify that using the help of wicks. So in this case there is a bigger wick, and that is what, with that we can identify that it is a rejection. It is not an acceptance, and in this particular case we can think of playing the opposite direction trades here, so not the long trade. In the first example, market closes above the previous day high, and with a decisive manner. There is not much of a wick, and we can call this as an acceptance. When there is an acceptance, if market again breaks the high of this acceptance candle, we can expect market to move in the upward direction. In simple words, if there is no wicks against to the flow of the market, then we can expect market to move in that particular direction, or we can expect the breakout kind of a movement. In other example, if there is any rejections in the form of wicks, in the presence of wicks, we can think of deploying the opposite direction or mean reversion trades in such cases. Let's look into few of the real life examples. As you can see here, this is an example of Nifty Bank. I'm using 15-minute chart here. Okay, so as you can see here, this was the previous day's range. Okay, so this was the previous day's range, and in this case this was the, just a moment, this was the PDH and this was the PDL, right? So now market opened here, right, within the previous day's range, and after that, as you can see here, just give me a moment. Yeah, so as you can see here, focus on this particular candle, market breaks. So market breaks decisively the PDH, right? Market breaks the PDH decisively, and as you can see here, there is no even single point of interest from the higher level, and we can call it as an acceptance of what? Acceptance of the bullish trend. And after that, as you can see, market moved in an upward direction in a stronger momentum, with a stronger momentum. So I hope this point is clear. This is a real life example. Let me show you few other examples in the same scenario. So here is an example of a short trade, right? So this was a PDL, right? PDL. When market approaches here, as you can see, focus on this particular candle, even though there is an interest, not much of an interest is there, and there is not much of a bigger wick, and with respect to this, we can call it as an acceptance of the bearish trend. And after that, market started moving in the upward downward direction with a good momentum. So I hope this point is clear to you. Now let's look into another example, that is an example of a rejection, right? So focus here, this was a PDH, right? PDH. Market approached to this level in the initial hours of the market. I think within 1 hour market approached here. This was an example of 28th, the last month 28th. So here, as you can easily see here, that I have marked this particular candle. Focus here for the marked candle. In this particular case, we are getting kind of a rejection at the higher level. We are getting a rejection, and we are getting the confirmation of that rejection in the next candle itself. As you can see, the low of that candle got broken, and immediately we can get into a short trade here, right, by targeting at least PDL. Don't worry, complete strategy I will be discussing later, but let's try to focus on this particular example here. So this is an example of rejection. Market rejected at PDH, and after that we got the very good downward momentum in the markets. Now if you look at this example, the rejections or the acceptance also can happen in the beginning hours of the market itself. That is the example I'm showing you now. This is very important. When market opens gap up or gap down, very, very important. So this was a PDL, this was a PDH, right? So market opened somewhere here, and which is below the previous day's low. When that happens, right, what it means is that in the opening hours itself, there is a negative sentiment, right? So if the bears are so strong, obviously they should move the market in the downward direction, right? Market should move in the downward direction. But what happened here? Focus here. This is where the rejection points comes in. So the initial hour sentiment was clearly rejected in the first candle itself. What happens in the first 15 minute and first 30 minute is very, very important. In fact, it lays the foundation for entire day. That's exactly what we are seeing now. So as you can see here, there was a clear rejection in the opening hours of the market itself, and after that there was no looking back. Market again traded in the opposite direction of the initial sentiment of the market. So this is an example of rejection, right? So rejection or acceptance can either happen at the key levels or also happen at the opening hours of the market if the market is opening beyond the previous day's range. I hope this point is clear. And now let's look into some other example. Here what happened, this was a PDL, this was a PDH, and market opened below the PDL, right? So that means what? There is a negative sentiment in the market in the initial hours of the market. Point one. Point two, you can observe the first candle here. We can easily identify by just looking at the candle. It shows that acceptance of the market. Acceptance of who? Acceptance of those who sold the market, and that resulted in the gap down. So initial bearish sentiment of the market got accepted, and after that, as you can see, even though there was a small pullback, market ended in a very downward direction only. At the end of the day, market trended in the downward direction. So it make all sense for us if we are seeing any kind of acceptance. Market, suppose market is opening beyond the previous day's range and we are seeing the acceptance in that direction, it make all sense for us to align with that particular direction. Point one. Point two, if there is no acceptance, instead of this, if the market is getting rejected in the initial hours of the market itself, we can think of buying the market, or we can think of mean reversal trades on those days. Now let's discuss about the strategy point. I hope most of you have already got an idea about entry, because so far whatever we have discussed with respect to the acceptance and rejection is all about identifying the direction of the market. So ideally, if the market is opening within the previous day's range, we are not going to identify the direction just immediately based on any particular price movements. We are going to wait for price to approach to the PDH or PDL. Based on that, we can think of further direction or further entry into the market. Otherwise, if market is opening gap up or gap down, based on the initial hour sentiment, we are going to define the direction of the market. I hope you are with me so far. Let me give you another example here, right? So here, immediately first thing that we do is we mark PDH and PDL, right? So market opened within the previous day's range. What we can do? We don't do anything. Patiently we wait for price to approach to either of the level, PDH or PDL. If it is not approaching, if it is trading within this, there is no trade for the day. So that is how we should be. That's what, I wanted to mention it. The first important element of today's discussions, today's strategy is the patience. So as long as you have the patience to wait price to reach to the key levels, you are not going to do anything. So patience is going to play the very critical role in our strategy. So market opened within the previous day's range. We're not going to do anything. And here market approached. Focus here, right? This particular candle. Market breaks. I want you to type down in the comments whether is it a breakout or false breakout, or is it an acceptance or rejection of the bullish trend. Well, it was an acceptance of the bullish trend, and as a result, you can see market trended in the upward direction with decisive manner. That's what very, very important for us. In this case, market opened within the previous stage range. We waited for price to approach to the key level, and here market gives the acceptance for this bullish trend, and after that we are getting into the long trade where we can take an entry. First element of the strategy, how can we take an entry? Once we know that this is a acceptance point, and we can simply get into a long trade above the breakout candle, above the acceptance candle. We can keep our entry trigger, and where we can keep stop losses, there are many variations we can keep our stop losses with. I'll be discussing about that in a different section altogether. So here I'm discussing about the entry. First thing, we defined the direction based on the market openings and the sentiment, initial sentiment of the market. Once we are clear with what we need to do, in this example we need to wait for price to approach to the PDH or PDL, either of the levels. Here market approached to the PDH, and we are going to patiently wait what kind of patterns that evolves with the market. Here it was an acceptance, and based on that we considered that we need to trade the long trade, and we placed our trigger at the high of the candle, which is where we got the acceptance, and that's how we get into a trade with respect to this strategy. Let me give another example here. So this was a PDH, this was a PDL, right? This is the day you wanted to trade, and in this example, assume how beautifully it played out. So basically, in the initial hours of the market, the first candle itself breaks the PDH, and what kind of breakout it is, or basically is it a rejection or acceptance with respect to the bullish trend, right? It is an acceptance. It was an acceptance, sorry. So it was an acceptance, and because of that, we got a very good upward momentum, especially if the market, initial hours of the market itself closing above or below the market in a decisive manner, or if we are getting an acceptance in the beginning hours of the markets itself, there will be a higher chance that we can get this kind of trending moves. So that's what we witnessed on this day. So where we can get into a trade after completion of the first, this is a 15-minute chart. After completion of the first 15 minutes, we can place our stop, we can place our trigger, entry trigger, long entry trigger just above this particular candle. We can get into a trade. Let's look into the new example. So here market, this was a PDL, right? This was a PDL, this was a PDH, right? PDH, extreme points. What happened? Market opened, this was the first candle, and market opened within the previous day range, and immediately in the first candle itself, market closes below the PDL in a decisive manner. As you can see here, observe the first candle of the chart here, and that was a very decisive close. So you can simply get into a trade just below that particular candle by keeping trigger. So basically, low of that particular candle will become your entry point. Then you can see after breaking of this particular level, a beautiful good downward momentum happened in the market. So as I said, in the initial hours of the market, first 15 minutes, 30 minutes itself, you are getting a breakout or basically acceptance in the beginning hours of the market. That will be a very strong signal for us to capture the bigger momentums. So let's start our trade case studies using this example here. It was on 18th April 2024, and this was a, let me mark that, this was a PDH, this was a PDL. What happened in the initial hours of the market? I want you to know, I want you to write down in the comment, was it a acceptance of the bullish candle or a rejection of the bullish candle in the initial hours of the market itself? It was a clear rejection, because you can see there is a bigger wick in the initial hours of the market itself, and after that we got a downward momentum, right? So where would I have entered? So basically, a low of this particular candle would become your entry point, or basically the swing low breakout also could could also consider as entry trigger. You can see that on that day we got a very good downward momentum. Let's look into another example here. So next day itself, okay, so now I want you to focus here. This was a PDL, right? So around 46,976, market opened here below the PDL, right? And in this case, we look for the initial hour sentiment. Was it a rejection or was it an acceptance? I want you to answer. Just look into this candle, the initial 30 minute of the candle. It was a clear rejection of the bearish sentiment that happened in the initial hours of the market, and let's see what happened on that day. You can see there was a good, in fact, a very good upward momentum on that day. This is the power of acceptance and rejection. So next day, what happened on the 24th? Let's look into that example. So here, focus on the last candle. Market opened within the previous day's range. What we need to do? We simply need to wait for market to approach either to the low, which is at around 47,900 in this example, and 48,300 was the PDH. Let's see what happens. Let's the market approach to either of the levels. I think market entirely traded sideways on that day, and market closed within the previous day's range. So we didn't do anything because there was no opportunities, right? Next day, market opened below the PDL. This is where the PDL was, 48,032 level, and next immediately first 15-minute candle and second 15-minute candle. So basically 30-minute closed positively. So in fact, the first 15-minute candle itself, it was a very clear rejection of the bearish momentum, and we can easily get into a long trade just above that particular candle, and you can see what happened on the next momentum. In fact, in the first initial hours of the market itself, the previous day's high target was triggered, and even in fact throughout the day market moved in the upward direction only. There was no presence of the bears. So this is a power of acceptance and rejection. Now let's talk about the exit point, where we have, see, the thing is, each person has their own persona, and based on their persona they can define their entry and exit. So entry point is clear to us. Exit was, there are many creative ways with which we can exit the trade. First thing, there are two types of exits. Let me write down. One thing is initial stop loss, right? ISL, initial stop loss, where what it means is that the moment you get into a trade, for example, assume that you are getting into a long trade here. The moment you enter into the trade, you are going to place a stop loss. That stop loss is called as an initial stop loss. Once the initial stop loss is done, if market started moving in our favor, right? So in this case, market started moving in our favor. In this particular case, to secure our profits, to safeguard and to reduce the risk, we also trial our stop loss, right? Most of the traders does this. So this is what we call as trailing stop loss. Let me give you a simple way to handle this thing. So basically there is an indicator called super trend, right? Let me add that. If you just type this, you'll get that super trend, and I'm going to change this 1.5 or 2, let's say 2 only, right? There are two in terms of the settings, length and the factor. 2 points are there. I'm just going to change the factor here, and I'm going to keep it as 2, right? So the moment it does, what this indicator does is, it takes the present volatility of the market, which is basically called as ATR, right? Average true range. In simple words, if we look back last 10 candles, right? So if we look back last 10 candles, what is the average range of those candles? So assume that the first candle's range is 50, second candle's range is 50, third candle's range is 100. Total how much? Total 200 divided by 3 is where you get the average of those 3 candles, and that is what you are going to call as, that is what we call as ATR, right? You know the average true range. The moment you are considering average true range here, means you are considering the volatility part in the market. I hope this particular point is clear. You are taking an account of volatility. Based on that, you are going to utilize that information to trade different things. So in this particular case, we are utilizing this to exit our trade. You can focus here what this indicator does. As long as, say for example, you entered the long trade here, right? So this was a long signal, and initially it will also help you to place your initial stop loss. So when you are entering the long trade, right, where the indicator was at somewhere around here. Assume this example sake, assume it is 10,000 price level. So you are going to place your stop loss at 10,000. That is your initial stop loss. What happened later? So market started moving in our favor, right? So when market started moving in our favor, along with that movement, the indicator also started moving in that particular direction. So as long as for example, you are trading in a 15-minute chart. So this is a 15-minute chart. Every 15 minutes you are going to adjust your stop loss based on the indicator's movement itself. So in simple sense, the indicator help us to place the initial stop loss, and also it helps us to trial our stop loss according to the movement of the market. And the beauty of this indicator is that the volatility is already considered in the market. So unnecessary stop loss triggers, unnecessary chop outs will not happen in most of the cases. So this is how we utilize this example. Let's look into the example of a short trade here. I think this is where only we have the stop loss. Assume you are getting into a short trade after this breakout. Okay, this is your entry, short entry. Where would you place your stop loss? Point 1, that according to the instrument you would place your stop loss here. If you think this is wider, if your risk management is not suitable, or if you are not able to take any positions, if you think this is a bigger, wider stop loss, you can consider the breakout. In this case, we are trading the breakout. This is a breakout candle, right? The high of the breakout candle itself also could be considered as your initial stop loss. Once the super trend crosses this level, you can consider trailing your stop loss, because it does it according to the market's movement. So at the end of the day, since it is an intraday system, so if you are not getting any triggers, if your stop loss was not triggered, you can simply convert the stop loss to market order. Simply sense, you can exit your trade at the end of the day. This was the end of the day candle at 3:15 p.m. or based on your broker's comfortable time, so square off time, you can square off your position since it is an intraday system. So this is about an exit thing. So there are many other things with which you can manage your exits, but this is one of the simplest way to manage your exits. So if it is a breakout, you can consider the high or the low of the, for example, let's say it's a breakout long trade, right? So you are getting into the long trade here, and this is a breakout candle, right? If it is a breakout, then you can consider the low of that breakout candle itself as your stop loss. In this example, it was a short trade, that's why we consider the high of the candle as stop loss. So I hope this is clear. Let me now recap what and all we have learned so far. We understood the importance of extremes. Basically, with respect to intraday, previous day's high and previous day's low are going to play the very critical role, and that is what the core pillar of our today's discussion. Once we identify the previous day's high, previous day lows, we are going to wait for the price action of tomorrow. Suppose if the market opens within the previous day's range, we are going to wait for price to approach to either of the levels. Until that, we are not going to do anything. Point one. Point two, if the market is opening beyond the previous day's range, based on the initial hour sentiment itself, we are going to define the sentiment, and we are going to look for the trading opportunities based on that sentiment. In most of the cases, first candles or second candles high or low would become our entry triggers. And next, we understood the importance of support and resistance. By default, there is nothing called as support and resistance. There are key levels. The reversal points is what we are going to consider as a key levels. If the price is trading below the key level, we are going to consider that key level as resistance. If the price is above that key level, then the same key level becomes a support, right? Then we understood PDH and PDL and mid also. In most of the cases, suppose let's say market opened within the previous day's range and market approaches to the PDH and we get the rejections. In that particular case, you can immediately target the mid, previous day's range, mid price level also could be considered as target price for this trade. So then we understood the important concept of today's video, which is acceptance and rejections. How are we going to identify it? Based on the wick size, right? So if there is any rejection, especially at the key levels, if there is any rejections or support, we are going to consider that as a rejection and support based on the initial sentiment of the market itself. If the market is opening beyond the previous day's range, then we are going to consider the initial hours of the market as the sentiment, or initial hours of the market action itself to consider whether it is an acceptance and rejection based on the sentiment that occurred in the initial hours of the market. Now let's quickly discuss about the risk management methodology. Basically, risk is controlled by the position sizing. It doesn't depend on the risk that existed in the strategy. Strategy risk can define with respect to the volatility of the market, right? So the risk management comes with respect to the position sizing. You need to control your positions to control the risk in an effective manner. Let me give an example here. So for example, assume this is an example. This is where you are getting into a long trade, right? This was a long trade, and typically, in most of the cases, we would consider the low of the breakout candle itself as our stop loss. And in this case, our stop loss was at around 46,200 and 46,600 was an entry. So market moved in a very drastic manner in the initial hours of the market. So assume it was 100, right? So just for an example purpose, the difference between your entry and your initial stop loss was 100 risk point, right? Assume you are ready to risk 5,000 rupees now, right? What would you do? You would divide this number 5,000 divided by 100, that is a risk point in the strategy, so 50. By opting 50 or lesser than 50 quantities, you are making sure that you are not going to lose more than 5,000 rupees in this particular trade. Similar example, next trade, assume you got a long opportunity, and in that case risk was only 50 points, right? Same 5,000 rupees risk, but now you need to divide this with 50 because your strategy risk is 50 points. So how much? 100, right? By opting 100 or lesser than 100 quantities in this trade, you would make sure that you are not going to lose more than 5,000 rupees in this trade. So irrespective of the market momentum, irrespective of the market behavior, if you are controlling this position sizing, you are making sure that you are not losing more than 5,000 rupees. Assume in the same example, instead of this 50 quantities, you would opted, you opted around 200 quantities, right? It worked in your favor, then it's good. But what if it didn't work in your favor? See, in the same trade where you are supposed your risk limit was only 5,000 rupees, but if you opted 200 quantities in this trade, you would be losing around 20,000 rupees, right? survival is the first key point, my friend. So if you want to survive in the market, you need to control the risk with effective position sizing. This is what the position sizing is all about with respect to the methodology. There are many other ways you can make your position sizing with respect to the lots also. For example, 1.5 lot, 1 lot I can trade. So nowadays margin requirements are also higher. So obviously in most of the cases, if you're trading future and options, obviously your risk would be defined. But if you are controlling this in an effective manner, obviously you would be trading at a very optimal position sizing, and the possibility of you getting a good returns or maintaining a sustained return without having any major drawdowns in the account is quite high when you maintain your position sizing properly. So it was a very simple and straightforward way to identify the trading opportunities. Most important thing is that we're not going to be in a hurry. We will be waiting for right opportunities at the right place, and that is what helps us get into a disciplined mindset. So basically, when we have a complete clarity of what we're supposed to do and what we need to do, how to wait and where to wait, what opportunities we should be looking for. If you give all this clarity to the mind, obviously the possibility of we becoming a disciplined and professional profitable trader is quite high. I hope you enjoyed today's video. If so, why not to like this video and share this video with your known circle. They can also get the benefit of this kind of information. If you have any particular questions, please do let us know in the comments. And most importantly, if you are someone new who is new to our channel, kindly consider subscribing to the channel so that you don't miss any of our future updates related to trading. And any information that I have shared so far is for educational purpose only. Don't consider it as a buy or sell recommendations. Before taking any decisions, make sure that you are doing a thorough research and then only take decisions, because every single investment opportunities are coming with a certain risk. Thank you so much for watching this masterclass. This is me, Nataraj, signing off. See you in the next video. Until then, take care. Bye bye. Jai Hind.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.